Merry Christmas! This is Adam Khoo, and in this video we'll be looking at the recent crash in Alibaba shares. In case you don't know, Alibaba is the largest tech company in China and also known as the Amazon of China. And recently, its share prices have fallen about 34% from the high, wiping out $100 billion in market value. So, is this an opportunity to buy a great business at a huge discount? Or should we stay away from this company because there's more problems to come? Let's explore this in this video. But before that, some important messages. Now, as a value investor, I love it when great businesses are hit by temporary bad news that sends its share price dropping 20, 30, 50% because it gives you the opportunity to again buy shares of great companies at huge discounts. And that's how we make great returns when the share prices eventually rebound. So what was the bad news at this time? What caused the share price to drop 34% from the high? Well, Alibaba has been recently hit by a lot of these bad news. It all started a couple of months ago when the founder of Alibaba, Jack Ma, aka the Martian from Mars Attacks, he criticized the Chinese government and he criticized President Xi Jinping, aka Winnie the Pooh. And you should never do that, right? So the Chinese government was pissed off. It's like, how can you criticize us? We are going to give you an early Christmas present to make sure you do not criticize us anymore, right? So what happened was the Chinese government, they suspended the Ant Financial IPO, which was going to be the biggest IPO in the history of the global stock markets. And Alibaba was a major shareholder of Ant Financial. Ant Financial is kind of like PayPal, Apple Pay, and Square into one. So they suspended the IPO, and that caused the initial drop of Alibaba shares from $317 down to about $260 US. This is the Alibaba shares listed on the US markets, ticker symbol BABA. So that was the first wave of bad news. And then on Christmas Eve, the Chinese government started to probe into Alibaba's monopolistic practices. Now, to be fair, the government is not just probing Alibaba, they are probing all the Chinese tech companies, kind of like the way the US government is investigating Google and Facebook right now for, again, monopolistic practices. So same thing's happening in China, okay? So the moment news of this investigation was announced, people panicked as usual and they started selling the shares, and from 260, the share price fell to a low of about 211 on Christmas Eve, but it rebounded slightly to close at about $222. So it's roughly about 34% drop from the high. So again, has it fallen enough? Could it fall even more? And is Alibaba still a great business? Is this a great opportunity to buy shares in this business to profit from the short-term panic and to make great returns on the rebound? Now, before we explore this further, let me just say that this really reminds me very much of two similar cases, two similar investments I made back in May of 2018. One of them was Facebook back then, and Tencent, which is also another big Chinese tech company. So if you remember back in 2018, Facebook had its own set of problems. It was facing investigation into the Cambridge Analytica scandal. So at that time, Facebook was at $217, and during that bad news, that scandal, it dropped all the way down to $122. So it was a 44% fall from the high. So at that time, I said, hey, this is a great opportunity to buy Facebook shares. You gotta be greedy when others are fearful. And it's a rare chance to buy a great business like Facebook at a huge discount. So if you remember, this was the video I made back in July of 2018. And again, if you watch that video, I said, this is the time to start buying Facebook shares. And we bought it at a huge discount. And sure enough, the share price rebounded eventually back to new highs. So you can see that Facebook shares hit its bottom on the 200 moving average on the weekly candles at about 122. And it rebounded but then came back down again during the COVID crash this year, which was a second opportunity for investors to get back in again, once again hitting that 200 moving average and then flying all the way back up to now it's about 267, and it's about 118% rise from the bottom during that initial crisis. Now, of course, we can't always catch the exact bottom. We can't always know where's the exact bottom, but as long as we buy when it's undervalued, when it's near the bottom, it's good enough. We're going to make money once the price eventually rebounds. If it's a good business, it always goes up. You know, people always ask me, Adam, how can you buy when it's a falling knife? When you buy great businesses, it's not a falling knife. It's a bouncing rubber ball. The ball will eventually bounce higher, okay, once it hits its eventual bottom on the moving averages. The second example that this reminds me of is Tencent. Now again, Tencent is also one of the largest tech companies from China, and Tencent is the largest online gaming company in the world, much bigger than Electronic Arts or Activision Blizzard. So Tencent, ticker symbol 700, listed on the Hong Kong exchange. You can buy it on the US exchange as well, under TCEHY. Same thing happened. So 2 years ago, Tencent had its games banned by the Chinese government, right? The government was like investigating Tencent, banning the games, and sure enough, this bad news caused the share price to drop from 476 all the way down to 252. That was a 48% drop from the high. And once again, I said this is an opportunity to buy a great business at a huge discount, and this was my video. So do check out this video, which I posted on the 4th of October 2018, where I talked about, at the time, Tencent Holdings, when it plunged because of the temporary bad news. I said, you know, we're going to buy right now. It's really undervalued. And sure enough, we made a lot of money once it rebounded. So you can see that for Tencent, again, it kind of like hit the very strong support at 252. This was the strong support, 150 moving average on weekly candles. It then tested this support again multiple times until it finally broke out of that consolidation. And right now, it went to a high of about $630, retraced recently to about $556. That's still a 120% gain from that bottom of that bad news. So once again, you can see that we can make really good returns when we buy great companies when they're hit by temporary bad news, when their share price is selling at a big discount. But the question is it the same case for Alibaba right now? Is it going to rebound eventually? So these are the 4 questions we have to answer before buying shares in such a stock. Question number 1, is Alibaba a great business? Remember, when it's a great business, it's a bouncing rubber ball. No matter how much it drops right now, it's going to go up even higher eventually. If it's a lousy business, it's never going to come back up. It's going to drop and never come back up. Okay. Question number 2, what material impact will this investigation have on the business? In other words, because of this investigation, what's the worst that could happen? Is it still going to be a great business to invest in? Question number 3, what is the intrinsic value of the shares? And at the current price right now, is it fairly priced? Is it undervalued, or is it still overvalued? And the last question is, what's the best time to enter this investment or trade? And for that, we look at the technical analysis, the charts, we analyze the trend, the support levels to identify high probability entry. So we're going to cover all this and more in this video, so stay tuned. So question number 1, is Alibaba a great business? In case you don't know, Alibaba is the world's largest e-commerce business in terms of GMV, gross merchandise value. So Alibaba essentially has 3 main lines of businesses. Number 1 will be e-commerce. Now, in the Western world, when you think about e-commerce, what do you think about? You think about eBay. You think about Amazon, correct? Top of mind recall. Now, in China and many parts of Asia, if you talk about e-commerce, the top of mind recall would be Taobao, Lazada, and Tmall, and they are all owned by Alibaba and Alibaba itself as a platform. So that's the first business, e-commerce. Its second business would be cloud computing. So it competes with Microsoft, with Google, and Amazon in cloud enterprise solutions. And the third business is in digital media and entertainment. It owns a company called Youku, which is the Chinese equivalent of YouTube. You guessed it. All right. So what do you mean by Alibaba is the world's largest e-commerce company? Well, in terms of gross merchandise value, in other words, the value of goods sold online, Alibaba is the biggest in the world. It is bigger than Amazon and eBay combined, right? To give you an idea, you can see over here, total gross merchandise value, or GMV. eBay sells $95 billion worth of goods a year. Amazon sells $335 billion. Okay, Alibaba alone sells $1.075 trillion of goods online. So you can see again, it's more than both these giants combined. In terms of monthly active users, Amazon has 200 million monthly active users, eBay has 66 million, and Alibaba has 846 million active users. Not that crazy to understand when you realize that China has the biggest population in the world. All right, China's population is more than more than 4 times the size of the US population. But in terms of revenue, all right, so again, remember that Alibaba sells mainly in Chinese yuan, and of course it's lower versus the US dollar. So in terms of revenue, Alibaba is still lower. All right, its revenue is 86 billion compared to Amazon, which is 347 billion, and eBay 11 billion. So in terms of revenue, Amazon is still a lot bigger than Alibaba. But in terms of profit margins, profitability, Amazon only has a 5% net profit margin, eBay 21%, but Alibaba 22% net profit margin. So it's actually more profitable than those two other companies in terms of percentage profits. In terms of growth, Amazon is growing at 28% a year, eBay 6%, and currently Alibaba's revenue is growing at 46% a year. In terms of market capitalization, the value of the shares in the market, Amazon is 1.5 trillion, eBay 33 billion, and Alibaba 692 billion. And of course now, because of the crash, it's down to about $590 billion. So that's a rough comparison of Alibaba's position in the marketplace. So Alibaba owns many platforms, many subsidiaries, right? In terms of B2C, it's very similar to Amazon. So businesses selling to consumers. So Alibaba sells under these brands, which is Tmall, known as Tianmao, Fresh Hippo, which sells groceries online, and then it's got C2C, which is consumers selling to other consumers. This would be very similar to eBay, right? So in China, their version of eBay is known as Taobao. Okay, in Asia, they do the same thing except under the brands Lazada and AliExpress. And like I mentioned, they also own Youku, which is their version of YouTube for Chinese people, because Chinese people can't access YouTube, so they watch Youku. Okay, and they also do a lot of B2B wholesale businesses under the Alibaba brand. In addition, they are also into enterprise cloud solutions. They've got Alibaba Cloud, which is competing with, again, Microsoft and Google and Amazon in cloud computing space. And again, finally, digital media and entertainment. So a lot of the movies that you see recently actually produced by Alibaba. Okay. Now, what makes a great business? Again, as an investor, I only want to buy great companies. A great business is one that has a history of consistently increasing sales revenue, net profit, and cash flow from operations. That's the first thing I look at. So take a look at, does Alibaba pass this test? Yes, look at revenue. You can see its revenue growing consistently every single year. And I only want to invest in these kind of businesses. Number two, let's take a look at net profit after tax. As you can see, net profit or net income also increasing consistently every single year. regardless of the recent COVID crash or the past recessions, because it's in a secular growth industry, e-commerce, and again, cloud enterprise, right? Next, cash flow from operations, again, growing consistently every single year. So it's got a fantastic track record of growth. That's the first thing I look at. The second thing I look at is I only buy companies with a sustainable competitive advantage that prevents competitors from taking away its market share. And Warren Buffett calls this an economic moat. So does Alibaba have a sustainable competitive advantage that protects it from its competitors? You bet your ass it does, right? So there are three sources of its wide economic moat. Number one is Alibaba is a brand monopoly in China. Has what is known as a top of mind recall, right? If you mention cola, right? Top of mind recall Coca-Cola. If you mention social media, top of mind recall Facebook, Instagram, Twitter. In China, it is known as WeChat, right? And of course, in terms of e-commerce, in the West, eBay, Amazon. In China and Asia, top of mind recall when people think of e-commerce is Taobao and Tianma, which is again owned by Alibaba. So it's got a brand monopoly. Number two, it's got what is known as a network effect, which means that everybody wants to sell on Alibaba. Everybody wants to buy on Alibaba. Guess why? Because everyone's there. It's known as a network effect, and that's its main competitive advantage. You don't want to go anywhere else because no one's there. Everyone's on Alibaba, in China at least, all right? And finally, economies of scale. So just like Amazon, it's like kind of like a big bully. It's so big, it can price its products lower than anyone else. It's got a huge cost advantage. It wipes out the competition, especially the brick and mortar competition. So it's got a wide economic moat. The next thing is, if you compare it to its competitors, who would its competitors be? In China, its closest competitor would be JD.com, another e-commerce website. And you can see in terms of market share, Alibaba has 55.9% market share. Next would be JD.com, and third would be Pinduoduo at 7%. And the rest would be very, very fragmented. So you can see it's got a really large position in the market. Next thing, what's driving the growth of the company? Now, this is really, really important. Why? Because if the growth drivers are still in place, temporary drop in the share price doesn't matter. It's a great chance to buy because it's going to go a lot higher over time as the company grows like crazy, okay? And the question is, are these growth drivers still going to be there if the Chinese government begins to clamp down on its monopolistic practices? We're going to find that out. But what are the growth drivers of Alibaba? There are two main growth drivers. Number one is massive growth potential in the cloud computing space. Now remember, Alibaba isn't just in e-commerce. They're also into cloud computing, and they're competing not with Chinese companies. They're competing with Amazon, with Google, and with Microsoft for the global cloud computing enterprise in the market, right? So cloud computing is projected to grow from 199 billion to 761 billion in the next 7 years. That's a 18.6% compounded annual growth rate. So it's an 18% growth industry, right? And Alibaba currently, because it's still relatively small compared to its competitors in cloud, you can see Alibaba Cloud recently year on year is growing at 60% on its most recent quarter, right? Now, compare it to Amazon growing at 29%, Microsoft at 31%, and Google Cloud at 52%. So definitely, cloud is one of its main drivers of growth in the near future. And we'll talk about it later that the government's regulation is not about cloud computing. It's more on its e-commerce practices. Alibaba's second growth catalyst would be expansions into the global market. Currently, it generates most of its revenues from China. Okay, China's e-commerce makes up 75% of Alibaba's current total revenue, while international commerce outside of China only makes up 7%. So there's a huge opportunity to grow the international business. And again, this investigation by the Chinese authorities is more into the Chinese economy and not so much the international economy. So this doesn't affect this growth driver as well. Now let's take a look at the overall e-commerce growth of the whole industry. So this is the entire e-commerce industry for China. And you can see that e-commerce sales as a percentage of total sales has been increasing from 30%, 36%, and now look at it, 63% of total retail sales are from e-commerce. 63%, that's way above the Western world, where the brick and mortar sales is still above e-commerce sales. In terms of the percentage growth or the growth of e-commerce sales, you can see that it's been hovering at about 20%, 21%, 19%, and 18%. So for the company itself, you can see that as the market leader, its last 5 years, its earnings have been growing at 27.1%. So note that down, growing at 27% a year for the last 5 years. And its projected growth rate by analysts who study the company are more conservative. They project in the next 5 years that its growth would be roughly about 21%. And this is really important because we're going to take a look at these growth projections in valuing the shares of the business. We know that Alibaba is a great business, but we have to answer the second question. What material impact will this investigation have on the business model, on its competitive advantage, on its growth projections? So first, let's understand what the government is doing. So the Chinese regulators are looking into Alibaba's practice of pressuring their online merchants into entering forced exclusivity agreements, essentially giving them the option of either listing their products on Alibaba's platform or none at all. So basically, Alibaba's competitors, Pinduoduo and JD.com, are complaining that Alibaba's being a big bully. They're unfair because they're telling their merchants that if you list on competitors' platforms, you can't list on our platform. So either us or them. So this is forcing merchants to choose, and because they're choosing Alibaba, they can't list anywhere else, and this is unfair monopolistic practice. So the government is probably going to go in there and say, you can't do that, it's unfair. You gotta allow your merchants to list on competitors' platform as well. So that's essentially what's happening. So what could be the outcome of this probe, this antitrust violation? So no one knows the outcome, but let's look at 3 scenarios. And the first scenario would be no impact or minimal impact. So in the first scenario, basically investigations would clear Alibaba of any monopolistic practices, or they may say, okay, yeah, you did violate some of the rules, so you're going to pay a small fine and I'm going to give you a warning, don't do it anymore. So that's the first scenario. So in this first scenario, I don't see any impact to the company's growth rate or its valuation. So in this scenario, it means that Alibaba is still gonna, business as usual, and that means that the share price is gonna be really, really undervalued. It's kind of like 50% undervalued. It's gonna be a great buy. Now, is this possible that they're just gonna get away with a fine? Possibly, and the reason is because this is not the first time they're getting fined. In fact, a couple of months ago, Alibaba and Tencent were fined for antitrust violations. And guess how much the fine was? Alibaba, if you read this article, Alibaba was fined 500,000 Chinese yen. That's only 76,000 US dollars. So it's pittance, it's a joke, right? It's like slap on the wrist. Go, you go, take it and go, right? So that's the first scenario. The second scenario could be a mild impact. So I think this is the more likely scenario, all right? So in this second scenario, I see that, there'll be moderate fines. They'll pay a small fine, and there will be slight changes to the company's business model that will prevent them from forcing these exclusive agreements onto merchants. So because of that, merchants can now list on other platforms as well, JD.com and Pinduoduo. So what would the impact be on Alibaba? Now, first, I don't believe that any merchants would leave Alibaba. No way, because again, it's a platform that everyone has to be on because it's the monopoly, right? But this would also allow them to list on other platforms. So yes, they could take away some business from Alibaba. But how big is this impact? How many merchants are being forced into this exclusive agreement? Okay, well, here's a clue. Recently, during a earnings call with analysts, Pinduoduo's management made a statement. They said that prolonged pressure exerted by dominant platforms on merchants to take sides. They are referring to Alibaba, of course, right? For the last 12 months, the pressure on brands and businesses have intensified, and over 1,000 well-known brand flagship stores have been affected on our platform, referring to Pinduoduo, right? With a total number exceeding 10,000. And this, again, is from the call with analysts. So essentially what Pinduoduo is saying is that because of this unfairness, 1,000 brands can't list on our platform of flagship stores and 10,000 in total. So what do they really mean? Now, remember that Alibaba has two platforms. Well, many, but the main two are Tianmao and Taobao. Now, Tianmao, their merchants include flagship brands like Nike, like Apple, the big brands. They sell their products on Tianmao, right? Now, there are a total of about 250,000 merchants. So what Pinduoduo is saying is that 1,000 of them are being forced into this agreement. Okay, so what is 1,000 out of 250,000? That's less than 1%. That's only like 0.4%. Okay, and they are saying that in total 10,000 merchants are being affected by this forced agreement. And let's assume that this 10,000 refers to Taobao, which are the rest of the merchants, right? So 10,000 divided by 10 million merchants on Taobao is 0.1%. So what I'm saying is that if the government stops this exclusive agreement, how many merchants are affected? The answer would be less than 1% of merchants will be affected. In fact, 0.4%. So it is pretty small. Okay. So how will this affect the company? How will this affect Alibaba? So first of all, I believe that Alibaba's current sales, profits, and cash flow will not be affected. What could be affected could be their growth rate. This may reduce their future growth rate because they lose some business to competitors. Right now, how much would it affect their growth rate? It's really hard to project, but I'm going to make a guess. I'm just going to guess that it's going to affect their growth rate by 20% in this mild scenario. In other words, their growth rate will fall by 20%. So I showed you earlier that their historical growth rate was 27%. Their projected future growth rate is 21%. So what is a 20% drop of 21%? So if you cut off 20%, that brings down their growth rate to 16.8%. So in this second scenario, I'm going to assume that their growth rate will drop from 21% to 16.8%. So write this down somewhere, because later on when I do a valuation into the company's shares, I'm going to use a 16.8% growth rate instead of 21%, which I used previously, all right? Now, of course, there's scenario number 3, which is the nightmare scenario, right? If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.